How to borrow money to flip a house. Don't have the cash? Good. Most successful flippers start by borrowing. The key isn't can you borrow, it's can you borrow the right way. In this video, I'm going to show you how to borrow money to flip without drowning in debt. By the end of this video, you'll know the smartest ways to borrow for a flip and how to structure it safely. If you type that question, I like the way you're thinking, because you're already thinking the way a successful investor thinks. How do I borrow money to flip a house? You don't have to use your own money, and a lot of people get stuck right there and never even go further. The fact that you searched it tells me you're on the right path. So let me answer your question. Because real estate is a hard asset, a piece of property, it gives you a lot more options to borrow money. Believe it or not, there's a lot more options to borrow money on a flip house than there is on one you're gonna live in. The one you're gonna live in, you go through a traditional bank or a mortgage lender, and that's how you get that money. That's not where you're gonna get money at all to borrow to flip a house, because banks have really no interest in being in the flipping game. They are in the long-term lending business where they can compound their interest. When you're in the short-term game, those are lenders that want to have short-term, much higher rate of interest, but it's also not compounded. In the end, it's actually a better deal for you because you can get the deal done. So let's talk about where you can get that money. One of the easiest places to get money is through a hard money lender. Now, a hard money lender bases their decision a lot on the property and not as much on your credit. Now listen, you can't be in the middle of a bankruptcy and be a deadbeat and have 1,000 late payments and have a credit score of 3. It can't be that bad. As long as your credit score is someplace at the very minimum in the high 500s and preferably in the 600 to 700 range, then hard money lenders are excited to loan you money on a deal provided the deal makes sense. So you have to buy the deal cheap enough so there's enough margin in the deal so they feel protected with their loan. They're going to put a mortgage on the property so they are protected, and they're also going to put a note on the property that defines exactly what you're going to pay them back. Now usually in that type of scenario you're going to pay interest payments for the duration of your loan. So if it takes you 6 months to flip a house, well, you're going to make interest payments for the 6 months that you own that house. Let me give you an insider's tip here. The cool part about being able to borrow money for a house is this. If you go through a hard money lender, usually they'll give you about 80% of the purchase price because they want you to have some skin in the game. They want you to see 20% that you bring to the table. Then they can give you up to 100% of the renovation costs of that property. So that leaves you with a gap that you have to cover. So let me talk about how to cover gap funding. Let's take some real numbers. Let's say that you're buying a house that the purchase price is $100,000 and the hard money lender will loan you 80% or $80,000 on that property to purchase it. Well, that's going to leave $20,000 that you have to cover. Again, the gap that you have to cover. So if you hear the term gap funding, you'll know what it is. So when you are covering gap funding, there's a lot of ways you can do that by using other people's money of your own resources. For instance, if you have a HELOC, if you have a home equity line of credit on your house, use that to cover the gap. If you can borrow against your 401k, use that. If you can borrow against your IRA, borrow against investments. If you can use credit cards. If you have some savings in your bank, maybe you can use that money if you want to, but cover that gap however you can, and if you can use other people's money, great. Now, if you don't have access to that kind of money, you're not dead in the water. You can now go out and get a private lender. Now, you might think of private lenders as funding the entire deal, and they can. And a lot of times they do, and if you do this right, you can, but it's sometimes easier to start small. In other words, you can ask people in your circle if they want to fund $20,000 and say, listen, think of how this sounds. I've got 80% of my deal covered. Like I've already got this covered. I just need $20,000. I've already got $150,000 covered over here. Oh, so I'm just a junior lender. Great. They feel a lot safer because you feel like you've come on saying, I've already got this covered. So now they can loan you money they become a private lender for you. In time, after you pay them back, they can then, if they have the money, they can actually be a full lender on the entire thing for you, which is a fantastic way to do it. There's no credit check, there's no application process. It's just people giving you money because you've built credibility with a private money lender. That's the mecca. That's where you want to get to, okay? But I want you to start right here by covering some gap funding with private lenders. It's a great way to get your feet wet in the private lender raising world. Now, there are ways you can borrow money for your flip or do this through creative financing where you're not borrowing from a hard money lender or from a private lender. And that is, you can do creative financing with a seller. You could actually have them be the bank. And you can say, listen, you hold the note from here, you be the bank, and I'll pay you off as soon as I flip the house. So they can become the partner with you on that deal. I've even seen deals where the seller has loaned money to the purchaser so they can actually cover the renovation costs, and the whole thing is paid off at the end of the deal, so zero money out of their pocket. The only limitations you have as a house flipper and financing is your level of creativity and what you can come up with. If you want to find some clever things and clever ways to finance your deals, make sure you spend some time on our channel and look at all the videos we talk about with creative financing and how you can get your deals structured. We cover all kinds of them inside of our channel. So when you borrow money, there is documentation. In other words, if you're borrowing money from a hard money lender or even a private lender, you're going to provide what's called a note that describes how much money you've borrowed and what the terms are, and a mortgage. A mortgage is a legal document that secures the amount of money that you borrowed to the property legally. So you can't sell that house without paying off the mortgage. Same kind of mortgage you have on your home. You can't, or your car. It's the same thing. They call it a lien on the car, but it's the same thing. The mortgage is just a lien on the house so that the lender is protected. That's the first kind of paperwork. The next kind of paperwork is, I want you to name your lender as an additional insured on your insurance policy. So if the catastrophic worst happens, the house burns to the ground, the first people that get paid out are your lenders, and your money left over would go to you. So we cover paperwork. What are the terms? Well, that depends. Hard money usually consists of a point or two, and a point is 1% of the mortgage. So if you borrowed $100,000, 1 point is $1,000. 4 points is $4,000. So there's a point, and that's usually how the broker gets their commission. And then you're going to pay anywhere from, I've seen them as low as 8%, I've seen them as high as 18%. Remember, it's a short-term loan, and that percentage rate is an APR, or an annual percentage rate. So that's how much it costs for the year. So in other words, let's say, just for easy math, let's say you borrowed $100,000 at 10%. Well, if you used it for the whole year, it would cost you $10,000 or 10%. You say, huh, well, but if you do the flip correctly, you should be out of that flip in 6 months. So that will cost you half, or $5,000 for the flip. And believe me, it is a really good investment to pay $5,000 to turn a $50,000 profit on a deal. So lose the battle to win the war. Don't psych yourself out with the amounts, because you're not buying a house on a long-term note. You're borrowing short-term from people that are willing to take a risk on you as a hard money lender. But you say, okay, how about private money? That's fully what you decide and negotiate with the lender. You can offer certain amounts and see what they come back with. Hey, I'll pay you 10% if you loan me that $20,000. Hey, if it's a gap loan, hey, I'll give you 15%. Hey, I'll give you a flat fee of $5,000 if I can borrow that money, or $2,000. You know what it comes down to? How desperate are you? And what will it take to get them to get the deal done? Lose the battle, win the war. The battle is the interest rate and the fees. The war is get that big fat check to come in from flipping the house. That's what you want to get. If you have to give up some of your profit to get there, so be it. Be as generous as you can be with a private lender without putting yourself in harm's way. Do I have to have a good credit score? Okay, let's talk about that really quickly. When you borrow from a hard money lender, credit is a factor. Having the best deal is the best factor, but credit's a factor. When you borrow if you decide to borrow from a bank, which is rare, yes, you have to have good credit. If you're using private money or any creative financing, no credit. They'll never pull your credit for those kind of deals. Now, I want to tell you this. Don't be a credit snob. You know what that means? A credit snob says, well, I have an 800 credit score. I'm not going to do any creative financing deals because I can borrow money from the bank. It doesn't matter. If you can get money from a private lender, that's the best way to do it. My credit score is well up in the high 7s and 8s, just depends on the month and what I'm doing and where I'm spending. But the truth of the matter is, we have borrowed over $10 million from private money lenders who have never checked my credit once. So don't be a credit snob. I think just because you have great credit, you're not going to use creative strategies or private money. Because if you can avoid using your personal credit, it also won't go on your personal credit report. And that keeps things clean for the future. If you're borrowing money, you gotta make sure it's for the right kind of property. Please do me a favor and check out my training right here on the crucial step that new investors always miss. Because we're gonna go over exactly how you can target the right kind of property. Because I'll tell you, when you target the right kind of property, it targets the money automatically. So go check out my training. The link is right here in the description below.